So you've probably heard of the stochastic indicator, right? It's a super popular tool for traders, but here's the thing. It comes with a hidden trap. Today, we're going to break down exactly what it is, how it works, and most importantly, how you can avoid that really common mistake.
You know that feeling, right? A price is just soaring, or maybe it's plummeting, and you're just sitting there wondering, when is this thing gonna run out of gas? It feels impossible. But what if there was a way to actually measure the momentum behind those moves?
Okay, think about it like this. Picture a rocket shooting up into the sky. Before it can fall back down to Earth, what has to happen? It has to slow down first. Its upward momentum starts to fade before its direction actually flips. Well, guess what? The market works in a very, very similar way. So how in the world do we measure this market momentum? Well, that's where our main tool for today comes into play, the stochastic oscillator. This thing was created way back in the 1950s by a trader named George Lane, and it has one simple job. It tells us where a price closed compared to its recent high-low range. In other words, it's designed to tell us if that rocket is starting to slow down. So that's the theory. But how do we actually use this in the real world? Let's pull up a chart and get practical. Think of the indicator kind of like a speedometer for market momentum. It's on a really simple scale from 0 to 100. 0 means momentum is basically dead, and 100 means it's at full throttle. But there are two specific levels on the speedometer that we really need to pay attention to. First up, we've got the 80 level. So when the stochastic line crosses up above 80, the market is considered overbought. This basically suggests that the buyers are going a little wild, and maybe, just maybe, things have gone on for a bit too long. And on the flip side, we have the 20 level. When the indicator drops below this line, we call the market oversold. This is a signal that the selling pressure has been super intense and, the market might be due for a bounce back. So this leads to a really simple and honestly a very popular rule of thumb. If it's overbought, you look for a chance to sell. If it's oversold, you look for a chance to buy. Seems easy enough, right? Okay, let's see how this simple little rule actually plays out on a real chart. All right, take a look here. You can see the price chart up top and the stochastic indicator is right below it. See that red dotted line? That's our 80 level. And notice how the indicator has been hanging out way above it for a while now, basically screaming overbought. So based on our little rule of thumb, what do you think happens next? If overbought means sell, where should the price be headed? If you guessed the price was about to drop, you were spot on. The market was so overbought for so long that a reversal was pretty much inevitable. And sure enough, the price tumbled. Now, that right there is the textbook way to use the stochastic. But, and listen, this is a huge but, it is not always this simple. And this brings us to a really crucial warning. I call it the overbought and oversold trap. As the source material warns us, an asset can stay overbought or oversold for a very, very long time. This is especially true in a powerful trend, and it's exactly where a lot of traders get into some serious trouble. Let me be crystal clear here. Overbought is not a command to sell, and oversold is not a command to buy. Think about it. In a strong uptrend, the market can stay overbought for days or even weeks while the price just keeps climbing higher. Selling just because the indicator is above 80 is a recipe for disaster. So what is our final takeaway from all this? It's simple. Don't be a stochastic sheep. This picture just captures the danger perfectly, doesn't it? Just because the indicator is flashing overbought, that doesn't mean you should blindly follow it and sell, especially if the rest of the herd is about to run right off a cliff. The indicator is a piece of information. It is not a trading instruction. So what's the right way to use it? Well, it's really a three-step thought process. Step 1, use it to gauge the current momentum. Step 2, identify when that momentum is hitting extreme levels. And step 3, this is the most important one, use this signal and confirm it with other information. Ask yourself, does this line up with the bigger market trend? What are the actual price patterns telling me? You got to use it as one clue in a larger investigation, not as the final word. At the end of the day, a lot of people treat the stochastic like it's some kind of crystal ball that predicts the future. But it's not. It's just a speedometer. It tells you how fast you're going and if you're redlining, but it doesn't tell you when to make a turn. And knowing that difference, well, that's what separates a smart analyst from a stochastic sheik.